I've got to tell you, the market is saying that your dividend is not sustainable because Dow's related to the price of oil, because Dow's related to giant cyclical portions of the economy, and that because the coronavirus is going to make it so you will have much less business. You're a worldwide company. You've already seen what happens in China. You're familiar with what's going on in Europe. Why is the market perhaps wrong about that judgment?
Well, our demand is good right now, Jim. And in fact, the last 2 weeks, we've seen our demand in China bounce back. And so I think when you consider that coronavirus incident started in February for them, and we've already started to see a recovery from that, I think that tells us that we can see the same thing wash through the economy here. When it gets to the dividend, I think people need to remember that we took a lot of actions in 2019 as we came out as the new Dow. We paid down $3 billion worth of debt. We also just recently tapped the Eurobond market for 2.25 billion euros of 1% debt, which we used to move our debt maturities out till the end of 2023. We started the year with $2.4 billion of cash. Our dividend is $2.1 billion for the year. And we've got tailwinds this year of another billion, which we have lower transaction costs this year versus last, and another billion of non-operating cash impact items. So I think what people are looking at, the market's full of fear, uncertainty, and doubt, and they may project that onto the dividend. But as you said, it's an artificially high dividend yield. We're in a much, much different financial position than we've been. And we did it deliberately to be ready to go into a down cycle after about a 10 to 11 year bull run in this market.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.